loan loss provisions really taking center stage here. Investors, for the most part, looking past the first quarter revenue and earnings numbers because clearly there's a lot of things that in the world that have changed since then. But what you can show us is the amount of damage that the banks are expecting in the months to come. Wells set aside $4 billion to cover bad loans. Give us some insight and color into how you arrived at that number, because there's a new accounting rule that requires banks to set aside provisions earlier in a cycle. How much of that $4 billion, for instance, is due to that versus how much is due to damage that you estimate is coming down the pike?
Thanks, Scarlet. Thanks for having me. So as it relates to loan losses, that's right. There is a new accounting standard called CECL that came in this quarter. Our provision, frankly, isn't terribly different as a result of CECL for this quarter. It is a life of loan estimation, but we analyzed our allowance under the old GAAP and under the new GAAP and came to similar outcomes. The difference in this quarter, and to get to the heart of your question, is that you're estimating via assumptions about the path of GDP growth, positive or negative, and the path of things like unemployment, home price appreciation, commercial real estate valuations, the S&P, a variety of things. You're estimating the impact on loans that you have on your books, and sort of front-end loading what the loss content might be if those particular scenarios play out. And because this is so early in this process, the facts really changed on the ground in March and even in the latter half of March. As banks were closing their books, folks are doing their best to estimate, create scenarios, run that through models, and set aside the right amount. So that's a big piece of it. Separately, though, because there are also some industries that are really directly impacted very visibly from the March and April change in economic activity. So I'd put transportation, like airlines and other transportation there, retailers, restaurants, leisure, auto sales, a handful of industries like that. And then lastly, things like entertainment, recreation, et cetera. So we built up an estimated reserve, also thinking about our exposures in those industries. And you can't forget oil and gas because of what's been going on at the same time with the slowdown in aggregate demand. So these things have a tendency to slightly overestimate. It's not necessarily true here because we don't know how long the economy is going to be locked down. We don't know when people are going to go back to work. But that's what's going on here.
So John, I'm Romaine here. When we talk about the idea of all of us getting back to work and hopefully back to play as well, we did see in your earnings as well as in J.P. Morgan earnings that sort of decline in credit card volume growth. I'm wondering, when you take a look at that metric and you take a look at consumer activity, how do those two line up for you looking forward into the future?
Yeah, well, I can tell you that in April, things changed drastically in the last 2 weeks of March as it relates to consumer spending that runs through our pipes, and we've seen overall spending down 35, 36% from April onward, and that's week over week versus the prior year. As you'd expect, or as you probably participated in, grocery stores and major online retailers tend to be doing better in this environment, up in the neighborhood of 40%, but restaurants, clothing stores, gas stations, and a whole range of other places that people were spending their money are down, big double digits to get to this average of about down 40%. And as I said, that for the last day by day, if you're comparing the same day to a year earlier, seems to have stabilized a little bit. And so the question is, when does that turn back on? How does that turn back on? People are not going to make up for missed restaurant visits, but there are some delayed purchases that folks will go out and act on when the time presents itself. But, which industries do better or worse, where employment, where sales turn back on that causes employment to pick back up immediately really matters.
So, John, expenses are obviously a big sticking point for investors, and it was a big sticking point, a big focus for Wells Fargo before the coronavirus. How much of this effort is being put on hold right now as the bank tries to help customers and help employees, offering grace periods, for instance, to mortgage borrowers, offering workers extra pay, pausing new job cuts during the crisis? Or can you do both at the same time?
You really can't do both at the same time, and the focus right now is on our team members and on our customers. And so we told investors on our call today that it's just as important as it ever was, and we will come to it. And we are just as committed to being as efficient a bank as any, given our size and scale. But right now, it's about making sure that employees are taken care of, people stay in their jobs, and that our customers are served in the way that they need to be served.